Yeah, that deal, like I said, downside, if you don't lease any space whatsoever and you're just going in and you have $500,000 or $600,000 in excess cash to pay leasing commissions, to pay tenant improvements, to pay, for a new roof, whatever happens, you don't lease a single space, you're going to get 10% a year.
Yeah,
it's pretty good. If we do our job, if we do what we think we can do, and we have plenty of money to go in and get those tenants and lease those spaces, then you're looking at 20, 21, 22% IRR in 3 to 5 years, which is a great little deal. I mean, it's hard to find a 20. I mean, how many people do you know that told you about a return they got in 20% that wasn't in crypto or real estate recently at all?
Yeah.
I don't know anyone. How's it going, everybody? Welcome back to How to Invest in Commercial Real Estate.
What is up?
And today is an exciting day because we are completing our biggest equity raise to date. It's already done. Closing on the first property. By the time you're seeing this, probably today, probably tomorrow. They're both in St. Louis. Anyway, today is just a deep dive and a thorough review of why we love the St. Louis Retail Fund 1.
Tell us, Braden, what would you say is the number one thing that attracted you to these two properties?
Yeah, so I think you've got great downside protection. Downside, you're looking at 10, 11% cash on cash, which I think is a great, reasonable return for being in real estate right now.
No big boxes to worry about.
No big boxes, no tenant bigger than, 10% of the gross leasable area. So, you can lose tenants. I think they're in great locations. And then you've got a clear path to upside because these are in great parts of town, great traffic counts, great little retail thoroughfares, several little vacancies that you can go in and lease up. Right, because you're going to get the value of that when you go to sell it later on, and I think they're great little properties.
Let's take them one at a time. Gordon and Farber, that's the one in West St. Louis.
Yeah, two deals. Gordon Farber is the one on the west side. That's 75% of the fund. That one we're picking up at a 7.5 cap on day one NOI.
A little bit aggressive from what we normally do.
It is, and I would say we did that because it's really well located. When we went out there, I mean, the traffic counts are just buzzing by that road. It presented really well. Good tenants. I think Sherwin-Williams is one of the bigger tenants. 9 or 10 years left of lease term on that.
You got DMV that's looking to take more space.
Yeah, they were in the middle of expanding. You have an Andy's frozen custard that's like 5 years old. They've already exercised their first option with another option, so you could probably spend that off for
To me, that was a couple of the factors that I liked that allowed me to get to the 7.5 cap.
Yeah,
a few things. First, the deal was good enough. We were able to get 85% debt, which is super strong. Another one is the vacancy that we can lease up.
Yep.
And then, like you just mentioned, the Andy's frozen yogurt, spinning that off. If we're buying at a 7.5, but we spin that off at a 6 with a renewal, there's arbitrage to be made there.
Yeah, that deal. Like I said, downside, if you don't lease any space whatsoever and you're just going in and you have $500,000 or $600,000 in excess cash to pay leasing commissions, to pay tenant improvements, to pay, for a new roof, whatever happens, you don't lease a single space, you're going to get 10% a year.
Yeah,
it's pretty good. If we do our job, if we do what we think we can do, and we have plenty of money to go in and get those tenants and lease those spaces, then you're looking at 20, 21, 22% IRR in 3 to 5 years, which is a great little deal. I mean, it's hard to find a 20. I mean, how many people do you know that told you about a return they got in 20% that wasn't in crypto or real estate recently at all?
Yeah.
I don't know anyone.
Yeah. Well, we were able to lock in debt with rates going up. We put a little pressure on ourselves to go ahead and take advantage of this deal because we could lock it up, because we had a great debt quote, and we're not sure, what's gonna be happening. I mean, debt is going up, and there's always going to be a lag between the debt going up and cap rates appropriately adjusting.
Yeah.
So to get this under contract and close it before we see a big impact on debt is a big deal.
Yeah. Since we're talking about the debt, let's stay on that for a minute. A lot of people ask us where we're getting the debt. The debt is a big value we bring because we can get more aggressive debt terms. It was a local bank here in Broken Arrow, Oklahoma, First National Bank of Broken Arrow. They couldn't even do the whole thing. They found a participant bank to pick up half of it in St. Louis. And, so we've got a deal in St. Louis. We've got a borrower in Tulsa. We've got a Broken Arrow bank doing half of it and the St. Louis bank doing half of it at great terms. And I'm saying that to say, if you're not actively working and shopping the debt, then you're not getting the best deal. I mean, the amount of banks we talked to on this and the amount of time we spent getting this debt is probably the most on the whole deal is just getting the debt involved. So when I say that's a big piece, it's a really big piece.
Well, and I would say another big piece of the debt and how we get the terms we get is we're personally guaranteeing it.
Yeah.
And there's a lot of sponsors that are never going to put their signature on the deal, and they may not even put any of their money in the deal. So what does that do for our investors? You may say, well, Joel, getting at 85% LTV, doesn't that increase the risk? It does, but mainly for the guarantors.
Correct.
Because if the deal isn't working, we're going to step in with our own cash because we're not going to be foreclosed on a deal this small compared to our portfolio size. So we really are committing to the deal when we sign on the debt. But we think our investors benefit from that because it allows us, the less capital you have in, the higher the cash on cash, and especially the higher the IRR on the back end.
Yeah.
Correct.
And this low rate that we're getting, that's less debt service that we have to pay. So that's more money we can return to the investors.
Yeah, you're acquiring Gordon and Farber at $140, $150 a foot, less than $150 a foot. I think it's $142, which, I mean, to replace this shopping center in this location would be easily double that cost. So, that's one protection you have. You're paying down the principal, obviously. Anyway, great deal. The second deal in the St. Louis Retail Fund 1 is on the southeast side of St. Louis, right? It's in Fairview Heights, Illinois.
Yeah. Illinois.
This one we're picking up at a 9 cap. Great little deal. It's in a great, retail thoroughfare. I would say it's a 9 cap because it's maybe pushed off the main drag, so to speak. 40,000 feet, 45,000 feet, picking it up in a 9 cap. The anchor tenants are Hooters. I think they do a few $1 million worth of sales there a year. And Sherwin-Williams, which has 8 or 9 years worth of lease term on it. Again, small mom and pop local tenants outside of the Sherwin-Williams. They've got leasing momentum. They just leased 5,000 feet back in December. That's being built out now. We've still got 2 vacancies to lease and go and add some value. One thing I didn't love about the center, it's got a 20-year-old roof, but we went back to the seller and we were able to negotiate a full roof replacement with a 20-year warranty. So we feel really good about that. And we're going in with $450,000 on this deal.
Now, when you say that, and I'm genuinely curious here,
Yeah.
You mentioned an amount on Gordon Farber and then you mentioned a separate amount. Is that for the fund or is that just for Marketplace?
For the fund, we've got almost $900,000 in CapEx, reserve, tenant improvement, and leasing commission, excess cash, ready to execute our plan and get those tenants.
Nice.
Okay, nice. That's quite a lot, actually. I think that would be more than we would normally take. But I think we've got new roof going in on Marketplace. We've got some parking lot repairs we're going to do. We have some vacants that we want to be aggressive on. We may offer TI, leasing commission costs.
Yep.
So that helps protect us on the back end to have that cash.
Yeah, and it helps protect the volatility of the investment. It helps protects, if we were going in and we were saying, hey, we're going to lease all this space, but we only had $200,000 in cash to do it. It's just not enough money to do it. If an economic downturn or some sort of weird pandemic were to come across, that's not enough money to do it. So we feel like we're being super cautious, but at the same time, we did go get 85% LTV debt on both of these. We're pitching a reasonable cash on cash return, and the value is leasing that space. So, we need to have the cash.
I want to go back to the location on the second deal because there's always you can always talk yourself out of any deal that we buy. And the way I could have done it on this one is it's like, think like if you're in Tulsa, 71st, in Memorial Mingo, but then, maybe go back
a block off that,
a block off that or 2 blocks off that where you're not really on 71st. Okay, we've got a picture here.
Yeah, so you can see it. It's right across from a big regional mall. You've got, anybody and everybody right there.
So the top left, you've got 90,000 cars a day on the highway.
Yep.
And then you exit the highway right in front of the main retail, and that's 40,000 cars. And some really good tenants. You got Hobby Lobby, you got Petco, you got Walmart, Home Depot. Everybody's here, and we are literally just behind the front row.
Yeah, even that road in front of us is almost 15,000 vehicles per day. So
right, and so for me, I wouldn't buy it at a 7.5 cap.
Yeah,
but what we did is we negotiated a new roof. They had good leasing momentum. We have decent traffic counts. And we got a 9 cap. Which is really. pretty good in today's hot market to be able to get a legitimate 9 cap. And then when we blend the two, I think it provides good returns and diversified risk.
Yeah.
Yeah, and I mean, the show's called How to Invest in Commercial Real Estate, so I think we can give a little bit of transparency. But I think our first offer on Marketplace was an 8.5 cap. And we went out there and we were like, hey, guys, this is not an 8 cap deal. This is a 9 cap deal. And it's a 9 cap deal with you giving us a new roof.
Yeah.
And I think so often we get too committed, we get too emotional. You're already flying out there. You know, if you've got hard sunk costs and airline tickets, whatever, you're excited. It's so easy to just say, okay, well, I'll do it. But no, you know, you saw things. You know, the roof was 20 years old. The parking lot needed to be replaced. It was off the beaten path a little bit, you know, and these things came back and we were like, yeah, it's a 9 cap deal. We sent in an offer and boom, we got it.
No, it's important to kind of go through the emotional aspects of buying, and you can't wait until you get into an emotional situation where you've flown in, you have time invested, you've worked on the LOI, to then try to decide what your standards are.
Yep.
So for us, there are population metrics we have to hit. There's traffic count metrics we have to hit. There's price per foot on the rent and on the purchase that we need to hit. And so all of those factors come into play. And if it deviates from those, let's say this is off the beaten path, then you've got to get something in return. And in this case, it's a new roof and it's a 9 cap deal, which is
price.
better than what we can get generally for a better located property. Maybe that's an 8 cap or a 7.5 cap.
Yeah.
Yeah. So a big value being created here is annual rent renewals and you know, rent growth through leasing vacant space and annual rent increases on lease renewals.
Yeah.
I mean, it's very clear, right? We're assuming no cap rate compression whatsoever, which means if we're buying it at a 9, we're selling it at a 9. If we're buying it at a 7.5 cap, then we're planning on selling it at a 7.5 cap. So we're not just creating fictitious value through cap rate compression. We got great debt terms locked in for 5 years. I won't spoil the interest rate, but it's sub 4. It's extremely low for today. Amortized for 25 years.
Now we can't get in. You can't get in this deal because once we launched, it oversold in a matter of days.
Yeah.
But we want to do this video so people can learn how we analyze the deal, what we like about it, what we don't. But also to encourage you is if you want to get involved, you have to get on our list ahead of time because the deals, they fill up pretty quick.
Yeah.
Yeah, and again, that's an important point is we have to fill out documents. You have to fill out documents as the investor that says how you heard about this deal. Right. And it's really important that your answer to that question is because you knew us, because you were on our email list, because of something. You can't you saw it from a Facebook ad. We're not allowed to advertise this deal. So guys, if you're not on the investor list, if you know somebody who might be interested in this, you've got to get them on our investor list because once the deal is launched, you can't come in. It's going to fill up immediately and then you missed out on another one. Anyway, St. Louis Retail Fund 1. The first deal is closing. It's probably already closed by the time we release this. The second deal is closing shortly. It's a great little fund. It filled up in a week. $2.6 million equity raise, and we are super excited for it.
Last point I'll say is if you think in your mind, looking at this or seeing it on our website, man, I wish I could have gotten in on that deal. Let us know because we're always looking for the next deal, and it helps us to know what our investors want to invest in and how many that we have out there with capital. That'll help us go find the next deal.
Good point.
Absolutely. All righty, guys. Well, thanks for joining us on How to Invest in Commercial Real Estate. And until next time, we'll see you then.
Thanks.